Hey there, welcome to the channel. So just going to do a little stock market update today. So here's our S&P 500 Spider ETF. So, it's interesting. So this thing kind of went down pretty good there. Let's do this. Let's try my annotating and I want to draw. Okay. Yeah. So basically here's our day here. And so we started out and, it gapped down and then it went down. But then it did recover a lot. So you have kind of a, you have a hammer there. So a hammer. So it's interesting to drop below this purple line is the 21 day, and then here's the 50. So like when you're looking at SPY, we can see that we got a lot of space. We have a lot of space between where it's trading and where the moving average is. So that, daylight is what I got to look up the name of that guy that I learned a lot of trading from. He had some great stuff back in the 80s and 70s and stuff. So yeah, so for the S&P, what we see here is, we have a little bit of a, and you're kind of getting, so it's interesting actually, because if you, let's see, clear on my drawings. Yeah, so if you look here, what's interesting, right, is it, kind of came right down to this support area here, this support area and bounced off it. So, for the SPY, for the S&P 500, this, of course, is, is like, it's holding up pretty well, down 0.6%. I mean, it did sell off, but the other thing too is we do have the volume down here. So it did kind of pick up on volume. So they did get to the S&P 500 today. I mean, that's what you could say is they really kind of did get to it. And so let's look at the NASDAQ. So the NASDAQ had been, correcting like worse, So basically, if you're looking at the S&P, today it did have a little bit of a recovery here. Once again, it did, in this case, the red line here is the 50. So it bounced off the 50 and then came back up. But, it kind of got killed this week and the last week, kind of that's pretty heavy duty, selling off there. And then also, if you look at the volume, pretty heavy volume there. So it's a pretty, decent sell off of the day. So interesting here, on the NASDAQ, you kind of have this resistance area here, right? And, what's interesting here is you had this W form up. It broke out of the W here and then kind of just pulled back, held above it, and then kind of went down. But now it's held right here. So this kind of area here, it's kind of interesting. We'll see what happens. But I mean, it's liable to not, the selling's liable not to be done. So, S&P 500, NASDAQ was much weaker than the S&P 500. So let's look at our 10-year treasury yield on the 3-month. So basically, it kind of like yields dropped and then kind of recovered today. So, this is kind of interesting. The yields are still 1.6%. They've kind of like arrested their fall. If we look at the, arrested their rise, pardon me. So if you look here, basically this is what happened. It had dropped, boom, 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 got up into this resistance area here, and it's kind of now stagnating in that resistance area. So whether the yields will go up more, who knows. Dollar on the weekly. See, the dollar here, like it really started to turn around and really was going to come up, but then it got hammered those 3 weeks. Just now it's back down. So, who knows? That one is the dollar. Yeah, because I mean, it's kind of interesting pattern. It's almost like a kind of a megaphone pattern, because you see that it's kind of like a megaphone pattern. So it's, kind of doing this kind of deal and it's widening up. So, I don't know. None of that really looks like a great kind of basing pattern at this point. But I mean, it could just kind of like base out somehow and then return. But who knows? So, so that's the dollar. So I guess like ARC. Now I don't know if this is the one, this innovation ETF, but there's a lot of talk on the tunes about ARC redemptions in the funds and stuff like that. So definitely the the ETF, this particular one, the ARC Innovation Fund, is definitely kind of like with the NASDAQ. So these are really with the I want to look at the 6-month chart, I think. Yeah. So really, this is kind of you know, here we go again. We're trying to find some support here. You know, it came down to this area. It's bounced off. In this case, the 200-day. So it is weak. It's consolidating, and you know, you blow the 50. So it's definitely not great. And then we have some of these other high beta, Churchill. This one same below the 50. You notice how the 50 is starting to turn down on some of these guys. So in a way, they're kind of not. You know, the 50 is now declining. So in a way, they're kind of not really doing that great. And then here, you know, gosh, look at Enphase after the earnings last week, and they got the crap kicked out of them. Really, really heavy volume too. So, I mean, if you look at it, you see, okay, whatever happened here, I assume that was the earnings. I know it was recent. I assume that was earnings. And then it just continued to get beat up. Now, once again, at the end, it kind of recovered a little bit, but this is it's trying to fight for this line, which is the 200-day. And you had some really big selling volume here. So maybe the selling is going to be done. Who knows? But, you know, once again, below the declining 50. So it's just not good setups at all. It's really not, you know. So, yeah, so basically the high beta. Everyone's pulling out of the high beta stuff, and except funny, GameStop they're holding on to GameStop. I mean, it's solid while everything else is getting killed. So someone's holding that thing. And then here's Neo. So the same kind of pattern as everything else. It tried to have a W, couldn't really make it, hit the 50, and you know hasn't really recovered. And then Tesla. Similar type thing. And here, like the Tesla, I had tried to, you know, I did kind of, you know, try a couple times. I think I tried to buy, you know, somewhere in this day here, because look, it started to come up above the 50. And, you know, I was talking about how you kind of have this sort of W set up, and what's happening is you got this resistance, and then it failed, and it put this little handle here, and it did pop up, but then it just couldn't sustain. And then here you had another day right here, it really popped up, but can't sustain. So it's just creating this downtrend. And this is all kind of almost like another type of a handle here, but because it almost flagged up the way it went these 2 days, it sort of created a flag. So yeah, it just doesn't look ready yet. You know, that's the problem. You know, that's the problem with the, you know, Kevin dude and everything. It's just like, it's not ready. And in the big picture, you still have an uptrend, right? On the weekly chart, still have an uptrend, and this thing is just in a consolidation, and it's been there for a long time. March, April, May, 2 months solid of consolidation. Put February in it because it made the decline in February, and then it's been in the range. So you got 3 months of consolidation, and that's how it works sometimes. The market actually moves really slow. It doesn't move as fast as people think. And then USO, as a representative of oil, interesting how it's just kind of going up, but, you know, is it getting sustainable out of whack here? Yeah, I don't know. You know, it had really got killed when the pandemic started, and then it kind of recovered. And now it's kind of, you know, it's definitely an uptrend here. So, you know, definitely that particular commodity. Let's just look at XLP, which I have some of this. And, you know, it's definitely stronger than the other stuff. It's holding up better, you know, which would make sense. Consumer staples holding up a little better. So that's kind of it. I know there was like a lot of talk from Yellen about like, oh, rates might need to go up and all that. And it's kind of funny because isn't that sort of obvious? I mean, it should be sort of obvious that rates might need to go up, but that seemed to like be part of the reason for the spooking of the market. Now, whether it is or not, you know, who knows? But and then apparently she's trying to back it up. So you can go watch everyone for that kind of info. But yeah, it's hard to say. I mean, you really just have to think that, you know, there's nothing is ever for free, right? And so this becomes a big issue. Is like, well, can you have something for nothing? Can you have stuff for free? And like we have this mentality now since the start of the cerveza sickness in March that like, oh, we can just do stimulus. We can just do all this stuff, and we can just like literally print the money, because we have no way of funding the deficits. There aren't enough countries, people, anyone able to actually buy all the debt. So we're not able to actually borrow the money. We don't really, to what extent we borrow it, we're not, I mean, the Federal Reserve is in there and they're doing their stuff to basically support that. if we had to have a more market-based system, if you didn't have the primary dealer network that's all hooked into the Federal Reserve, where the Federal Reserve can basically create bank reserves out of nothing, buy mortgage-backed securities, et cetera, all this stuff, which piles reserves onto the bank's balance sheet, so that the banks then have these reserves, so they can go out there and then use those reserves in different ways to try to get a hold of, just meet their commitments to buy all this debt. But if that wasn't there, I mean, you would have already had failed auctions. So, we're going to learn a really hard lesson here, because there's no way you can do this forever. There has to be a consequence. Everything has a consequence. And it's so funny, because we live in this very liberal society, and it's like, what's interesting, and I find this sort of annoying, that like the physics type people who really understand this, like sort of the core theory of life and stuff, they don't, it's not that, it's that they would understand the concept of, each action as an equal and opposite reaction. They understand that stuff. They understand the concept that, look, you can't just do everything for free. You have like in physics, you have conservation of energy and stuff. Nothing's for free. And yeah, there's some places where maybe that doesn't apply in modern physics, whatever, but generally they understand this stuff. They understand the concept that you're not getting something for free. Like energy and matter, you're not creating energy. It's always just, you're transforming it, right? You energy to matter and back, et cetera, or you're transferring the form of the energy that is being translated or changed, but you're not really ever losing energy, right? And so once again, I'm coming from a classical physics type of thing. I understand modern physics, there may be cases where this may not be the case, but so they would understand it. So the funny thing is, like, why don't physicists kind of understand that? And I'm sure they do, but it's kind of funny. They would be the people that would understand that, like, well, yeah, the Fed can't just create bank reserves and pile them high and have the banks just make bad loans. And they couldn't just do this forever without there being some consequence, right? But yeah, we have this entire system right now where we have like everyone, including, like, I guess physicists don't worry about finance, and they really should worry about finance. Like they should, they would be really good at it, but I don't know. They don't. We need like, what's her name? Hofster or Sabrina, right? From that physics lady. Yeah, she'd be great. She should like study some finance. I think she'd be pretty like, really? That's not a law. That's not. She'd be pretty critical of a lot of the stuff. I mean, if she actually paid attention to the Fed, she'd be like, wow, these people are just, they don't get it. This is nonsense. But yeah, so that's the kind of culture we have. The culture we have is that, like, it's sort of this group think. It's like, hey, we can print all the money we want, and there's no consequence for it. And I get the whole George Gammon thing about, oh, they're not really printing money, but they are making reserves. They're doing anything they can to stack the reserves up, get that stuff, take whatever paper they can take off the bank, so that the banks have excess reserves and more reserves, that at some point, you do enough of that, they're going to start trying to lend some of that. And I get the whole deflation thing too. I mean, obviously at this point, there seems like there's been some inflation, but the other side of the coin is maybe there hasn't, because there's been enough money destroyed in the fact that, but that hasn't really happened yet, right? So we're in, so the thing is, if we can do this, if we can pass these $1 trillion stimuluses, and we can go to like $4 trillion, and we can like start UBI, where paying people $1,000, $1,500 a month indefinitely to do nothing. If that doesn't cause, I mean, there's no way that can be done. There's just no way that can be done without there being a consequence. And the consequence is going to have to be inflation. There's no other way around it, because you have all these notes, all this currency chasing fewer actual products. And you have the two elements of it. You have one, less people working because they don't want to work, because why would I work at McDonald's if I can make more money being unemployed or more on UBI? I wouldn't do it, right? You wouldn't do it. So you're going to have less products and less services. So therefore, what money there is available, even if you didn't increase the money supply, that money would be chasing fewer supplies. I mean, it's very simple economics. It's going to tend to push prices up. And then throw on top of that increased money supply, and that will also do it. So, I mean, there has to be a consequence. And it's funny, because I was a kid in the 70s, but there was very high inflation in the 70s. I mean, like, you don't understand. Like, I mean, do you understand that gasoline was, I don't know what it was when I was a kid. I remember like different times. I remember when it crossed $1 on the way up, you know, it's like, wow, it's $1. It was horrible because it used to be like 5 cents, you know, at different times, 5 cents, 10 cents, 20 cents. And in the 70s, there was a lot of increases in gas prices and stuff because of oil prices, et cetera. And, um, and it just, you know, we just get used to it. But in each element of that, every time that happens, what you're doing is you're losing a little of your, you know, you're getting poorer, as Gammon would say, right? You're getting poorer because you have less goods and services, and they're costing more. And so you're actually getting poorer. So as a nation, we're getting poorer. So I don't know. I tend to believe that at some point this will come about. But I guess the thing with the big problem right now is what's going to happen with real estate loans, right? You know, what is going to happen with real estate loans? Because at some point, all these people that are not paying their mortgages, that are not paying rent, there's got to be a resolution of this. It can't go on forever. The landlord's like, look, I can't. They just can't. You have to get to a point where it's like, look, you got to either write the loans off, you have to foreclose on the buildings, you have to kick the tenants out that aren't paying. All this stuff has to happen. And when that happens, that's where you could have, it seems like a potential like decrease in the money supply, right? Because basically you have all these loans, and all these loans are sitting out there on books and they haven't been written off yet. And there's trillions of dollars of loans against real estate that's not performing. And at some point, you know, someone's gonna have to say, well, we admit it's not worth anything. And then poof, it just disappears. And part of that is, you know, it's part of the money supply. So it is deflationary. And so that's really the key to this whole thing, is like what's going to happen and when that's going to start. Now they're going to push it off as long as they can. I mean, there's plans to push it off maybe even another year. And I think the Biden administration will try to push it off forever, right? I mean, essentially, if they can just keep pushing and pushing it off, they're going to try to push it off. But basically, you know, if tenants aren't paying rent, the landlords aren't paying the mortgage, you know, at some point, someone's going to have to come in and say, hey, look, you know, landlord, I'm taking your building. And then the whoever takes the building is going to like kick the tenants out. Now, the one pure socialist thing that could happen out of this whole thing is what? Well, the Fed goes in and the Fed says, well, we're going to buy all this. They go and they say, okay, the Fed comes in, and what do? They buy the mortgage-backed securities into a larger extent than they are now. I mean, they are buying them, right? But they go in and they buy those things. That's how they take them. So basically the landlord sits here, the landlord says, I give up. And he's just like, I give up, he or she, and I'm done. Landlord gives up. Basically, the defaults on the mortgage, the Fed buys the mortgage. So let's see, the paper goes over to the Fed. So this would be your, it's going to be California. So it'll be a trust deed and TD, trust deed. That's what we have in California. Other places have actual mortgages. So basically the deed goes on the Fed's balance sheet because the Fed buys the mortgage-backed securities that holds the deeds, right? And so then it basically owns them. So now the Fed could go in and say, what does the Fed do? Well, the Fed becomes our socialist housing agency, right? Because if the Fed doesn't like actually, the Fed now owns the building. It owns the paper to the building. So that becomes in control of the building. So the Fed can just sit there, and all the people that are in this place that aren't paying rent will never have to pay rent. If the Fed says, look, I'm never going to foreclose and I'm never going to kick you out, then all these people that are not paying will never have to pay. And then this, at some point, this mortgage-backed security goes away. Now, who does maintenance on the building? Who knows? Because the landlord is still gone. The state landlord or whoever owned it before is like, look, I'm out of here. Screw this. Now the Fed is going to have some kind of housing agency. Maybe they'll kind of sign it to HUD or something like that. And what they'll do is these guys are going to have to spend trillions of dollars trying to manage all these properties that they have. Now, in the past, they've had to do this, you know. But what they've always done is they try to just sell these off. They basically get all the bad debts. They have the deeds to the building and they try to sell them. But here, you know, that's going to be the question. Do they sell them? to sell someone else that comes in and look, I get the building. The problem is if you're going to buy the building, you get a bunch of tenants in there, you can't evict, it's going to be a problem. Because remember, they just drag everything down. And of course, I feel for the people that are struggling. But you got to understand, there's a lot of people taking advantage of it. And that just seems to be the case. And it's sort of anecdotal at this point. But there's no doubt there's people taking advantage of it. And the people that aren't, if you have a big percentage of people aren't freaking paying their mortgage, that building is not viable. It's just not viable. So this really is the big thing. And I would think this year, but probably not. It's probably going to get pushed off till next year. They're just going to keep keep having, foreclosure bans as long as they can, and they just keep doing that. And so, the question is, are rates going to go up more? Who knows? Who knows? At this point, you get to this certain point where it's like, who buys this debt? The primary dealers, my understanding is they're like obligated. They have to buy this debt, so, and they have to be colluding. They have to all collude together with the Fed and figure out like, hey, the Fed announces and we're like, oh, we got $1 trillion auction for 3-month bills. And, all these primary dealers, there's 22 of them or whatever, they got to find a way to come up with the money for that. And so what they're going to do is obviously this is where the reserves come into play. They can put up the reserves, et cetera, and all that stuff, and then have the discount window and all that stuff that goes on. But at some point, you just kind of wonder. The problem is right now is there's actually seems to be, there's many arguments that there's a shortage of treasuries, the Gammon videos and stuff, there's actually a shortage of treasuries, so if there's an actual shortage of treasuries, it'll just keep this going on for longer. But at some point, if there is not enough treasuries, then that gets to be a problem. So I think that's it for this one. So I think right now, what am I doing? Like in the stock market, I'm not doing much. I just have I have my just S&P stuff with a little bit of hedging, but I'm kind of trying to pay attention and trying to figure out what's going on. But right now, all this stuff like these high beta guys, really if I look at it and say, hey, should Tesla come around? I would believe that there's a chance that Tesla will come around at some point, but it's just not ready. There's nothing to buy here. There's really nothing to buy. And in the long-term chart, if I was holding on it, long-term chart, you could still be holding it, right? So I don't know. So I keep looking for stuff, slow stuff that I want to, look at the, this is kind of interesting on the, let's go annotate, clear, all drawings. Yeah, look at the Apple. See, Apple's kind of interesting. It had gone up to here, weekly charts, so it's a very long-term chart. It hasn't not really going very far right now. It's kind of in a range. But look at here, it didn't really get up to this old high very much. Who knows if it will, if it broke through here, then it would have, potentially a long way to go. Here's some support, maybe a little bit of support here. Not until you really get into this area that you have heavy duty support. So interesting. So that's Apple. What are some of the other guys? So I don't know. I'm just kind of looking around for what might be. Amazon is so expensive. I could buy 7 shares of Amazon. But then look at that outside weekly day. Look at that big outside day, man. Just, here's the thing. It's funny, like we talk about how the stock market has just gone parabolic and gone up, and it sort of has, but like a lot of these stocks haven't gone anywhere. Like look at Amazon here. If you look at this thing and, basically it had a huge run here, right? Huge run. And then it's been static. It hasn't, like here, it made a chance right out here all the way back in August. It almost broke 3,500, but didn't. And it's just been everywhere in between. So it's just in a range, it's just in a range. What's happening now, though, is it sort of, came below the moving averages and stuff. So now it's got to like put up or shut up. When you start messing around the moving averages, you got to start making your move, or else, it's going to be a problem. So that's sort of the thing. I kind of wish some of these high beta ones, like really honestly, like the Neos and stuff would form up. But they're just not forming up. They're just really dangerous right now. And, the problem is, will the numbers ever will they ever meet the expectations for the numbers that they need to meet the expectations? You know, who knows? Who knows? So I think that's it for this one. So there is this old song, money for nothing and your chicks for free. So, well, money for nothing and chicks for free. That's the Fed policy. All right. Talk to you guys later. Bye.